Hello and welcome to Your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman. You know, the world is coming together a little more now, and I'm so excited to be back here in the studio once again with the founder and CEO of Hilltop Wealth Solutions, Eric Brenner. Now, for those who don't know Eric, well, he sold a family business nearly 30 years ago to become a certified financial planner. And he really focuses on developing genuine relationships with his clients because, well, the better he knows them, the more he can help them be successful financially. Eric, so good to have you back.
It's great to be back in the studio. I'm really excited.
Well, this week we are going to talk about why some people could benefit from Roth IRAs or Roth IRA conversions prior to potential tax changes. As we know, tax rates are likely to be raised in the coming months as a result of the recent $2.3 trillion Biden tax proposal. So more and more people are talking about Roth IRAs, whether they should open one, convert to one, you name it. Let's talk about some important reasons to do this right now. You know, it just seems this is really a matter for the experts. Just in case anybody needs a reminder, tell us the difference between a Roth IRA and a traditional IRA and how the process works for a Roth conversion.
Sure, yeah. So a Roth IRA was created actually in 1997 by Senator Roth, and it started off with $2,000 contributions, and it's after-tax money that grows tax deferred, and then when you take it out, it's tax-free. And when it first came out, you know, a lot of us thought that, is this really going to last? And it really has. And so now it's grown to, if you're over 50, you can contribute $7,000 if you qualify. And the difference is a traditional IRA is pre-tax money, grows tax deferred, but then you take it out, it's taxable. So now conversions have come about, and those also existed in different forms. And a conversion basically is to get taxable money over to tax-free money. Now what you have to do is you have to pay taxes on the money today, but that may be a better thing to do today because you know where the tax brackets are, and we're in a 40-year tax low. So taxes are probably going to go up, and that's why Roth conversions is more of a discussion today than what it was even 5 years ago.
Yeah, it really seems like a Roth conversion could be a really good idea for a lot of people. Can you tell us, Eric, what factors really determine that, whether a Roth conversion makes sense?
Yeah, it really does come down to the personal situation. Each situation is different. And, you know, we really encourage people not to go by what their neighbor does or their friend or their family member because each situation is different. And there is some tax money that's involved in it. They have to pay taxes today. It also depends on their tax bracket. And so I brought along a graphic that really shows here, if you take a look, shows buckets. And the buckets really are, you fill them up. And someone might not be in the next tax bracket, Tracy. And so what happens is they may have some room, if you will, in their tax bracket that they really can fill up, take advantage of the same tax bracket, okay? But then it's tax-free forever. And tax-free forever is always a good thing in our mind.
Absolutely. Seriously valuable information. So thanks so much for sharing that with us, Eric. Now we know that traditional IRAs, they have a required minimum distribution, RMD. What are RMDs though?
Yeah, so an RMD is when you get to age 72, you have to withdraw money out of your retirement plans. It's required. Even if you don't need the money in your cash flow to live, you still have to draw it out. In a traditional IRA, it's taxable. In a Roth IRA, you don't have RMDs. You can leave it in forever. It's never taxable. And so that's a big factor. Required minimum distributions, we are seeing these become larger and larger for folks because they have more retirement savings, because they're more responsible to save for themselves now more than ever. And so it can be a big increase in taxes as they get into their mid-70s and later 70s. So again, Roth IRAs may be an advantage to them.
And I'm curious, Eric, other than IRAs, are there Roth versions of other types of retirement accounts as well, like Roth 401ks, for example? And how might those be different from a Roth IRA?
Yeah, so there are many companies now offer a Roth 401k option. And so I would encourage people to really think through or determine at their workplace if they have a Roth 401k option. Because if they do, then they can save both in a traditional pre-tax 401k, so they're saving money today on taxes, and they can also save in a Roth 401k option. That's after tax. But we're really encouraging people at least to look at a 50-50 split, 50% pre-tax, 50% Roth, so that they really can take advantage down the road of this tax-free option. And the limits are the same as a 401k. It's just you can put in both of those pots, and as long as you go up to the limit, you're fine.
Wow, these are great tricks of the trade. And let's just say if you aren't catching all of this, there is help out there, because honestly, this feels like a place where people could use advice from a good fiduciary advisor like yourself and your fellow advisors at Hilltop. Explain to us a little bit about what that word fiduciary advisor means, what that is, and then I understand you have an offer for our viewers.
Yeah, so fiduciary advisor really, when you go to work with a financial advisor, they fall into a couple different camps. And a fiduciary advisor, must act by law in the best interest of the client. Now that may seem to be kind of natural, and you hope that would be the case, but there are advisors in the way that they're structured and licensed. They have a best interest that they must follow, some protocols there, but they're not a fiduciary advisor. And so that we really work for our clients, and we really look to the best interest of our clients. And whether that's saving in a Roth 401k, a Roth IRA, traditional IRA, and all the avenues and ways that they can save. Really the offer that we have is, oftentimes people don't know if they're on track in one area or another. And so we do what's called a retirement roadmap. And you can visit our website at hilltopwealthsolutions.com, find out a lot more. Retirement roadmap takes a snapshot look at forward tax planning, Tracy. Where are their taxes projected to go? Social Security. So what decisions did they make as it relates to Social Security? And the Biden proposal has some Social Security aspects to it that I know we'll talk about on future shows. And so it's really a great snapshot that if you would to purchase this, buy a retirement analysis, someone's going to pay $1,500 to $2,000, and we're offering it up complimentary. There's no, you're not committed, but we really want to give people an idea as to where they're at, and then some direction to help them make good decisions.
Absolutely. And there's so much peace of mind in that term fiduciary, knowing that somebody is helping you, working for you in an independent way, I think. Eric, one more question. When people are discussing their estate planning in relation to both retirement accounts, I've heard them mention something about a 10-year rule. Can you explain to myself and our viewers what this is?
Yeah, this does get, it's a new rule that with the Secure Act that was passed in January 1st of 2020. And basically what this is, with any traditional IRA money, 401k money that has yet to been taxed, okay? The new rule is that when you pass away, okay, and you pass the money on to a non-spouse beneficiary, so they're not your spouse, but your children, nieces, nephews, and so forth, they must withdraw all of the money that has not been taxed by the end of the 10th year, okay? And it can be substantial. Now that we're seeing these pots of money grow, okay, because this is the way people are saving money, it can be substantial, and it can put the person that's receiving the money in a much higher tax bracket. So as an example right now, federal tax brackets top out at the mid 30%, and you add state in there, you could potentially get into the 40% range. So on $1 million of inherited, you pay $400,000 just to taxes. So it's a big thing that people need to be aware of, and they can actually plan for it to help reduce taxes for their beneficiaries.
Thanks so much, Eric. And that about wraps it up. We are out of time for this edition of Your Wealth Health. For Eric Brenner and the entire Hilltop staff, I'm Tracy Capelman. Thank you so much for watching. We'll see you next week. And until then, stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.